Hello everyone. Today we will discuss the long-term solvency ratios. So we're doing two sums. So here is the question. Calculate debt equity ratio and proprietary ratio from the given balance sheet. So we have liability side, we have equity share capital, preference capital, general reserve, profit and loss account, debentures, sundry creditors, outstanding wages. Asset side, we have goodwill, plant and machinery, land and building, stock, investments, debtors, cash in bank. Okay, so first we will start with debt equity ratio. The debt equity ratio formula is long-term debts divided by shareholders' funds. Okay, so long-term debt. So when you look at the liability, we have only one long-term debt, that is debenture. Creditors and outstanding wages is our current liability. So long-term liability, we have only one item, that is debenture. So numerator amount is ready, long-term debt, debenture amount 1 lakh rupees. But then shareholders funds. Shareholders funds we need to calculate. Okay, so calculation of shareholders funds. So we will make two columns. Okay, particulars and rupees. Okay, so shareholders funds is nothing but we have to first take up the share capital. It may be equity share capital, it may be preference capital. Okay, number one. Number two, we have to add the appropriations. It may be a general reserve, any kind of reserves we have to add. Number three is profit and loss account. Then number four is proposed dividend. Number five, if at all we have any preliminary expenses in the asset side, we should minus that also. So when we look into this question, the first we have capital. First point is about capital. We have two capital here, equity capital and preference capital. Both we will take it here. Okay, third point is general reserve. Yes, we should take it. So next point is general reserve. So first point is capital, second point is reserve. Third point is profit and loss account, that is also given here. So we will take that thing also. Okay, now what is the next point? Proposed dividend, which is not there in the question. The last point is preliminary expenses. Preliminary expense also not given in the question. So that's it. We have to find out the total. So total shareholders funds. Total shareholders funds. How much is coming? 1 lakh 50, 2 lakh, so 3 lakh. So it is coming 3 lakh. Okay, so 3 lakh amount is the shareholders funds. So remember, shareholders funds is an addition of share capital. It may be equity, it may be preference. Number two, reserves. It may be capital reserve or general reserve. Next one is profit and loss account. Then proposed dividend minus preliminary expenses. So we got 3 lakh rupees. When we apply into this ratio formula, long-term debt is we have debenture amount of rupees 1 lakh divided by shareholders funds we got 3 lakhs. So which means 1 is to 3 is the ratio. 1 by 3. 1 by 3 or 1 is to 3 is the ratio. Okay. So this is how we should find out the debt equity ratio. Next, we will find out the proprietary ratio. Okay. So proprietary ratio formula is shareholders funds divided by total assets. Okay, so shareholders funds, just now we calculated, that is rupees 3 lakhs by total asset is nothing but our balance sheet, we have total asset as 5 lakh. So 3 lakh is the numerator, 5 lakh is the denominator. So we will be getting 3 is to 5. 3 is to 5 is the ratio, proprietary ratio. This is how we should find out the debt equity ratio and proprietary ratio. We will work out one more sum, that is interest coverage ratio. Okay, so interest coverage ratio is nothing but this ratio indicates whether the business is earning a sufficient profit to pay the interest periodically. Okay, so whether we have that ability, whether we are earning sufficient profit to pay the interest periodically. Okay, so first we will discuss the sum. From the following, calculate interest coverage ratio. Okay, so profit after charging interest on debentures and tax is 25,000. Interest is 5,000. Provision of tax is 10,000. Okay, so interest, oh, increase the font. So just, yeah. So interest coverage ratio, interest coverage ratio equal to profit before interest and tax divided by interest charges. Okay, so interest charge is given in the question, 5,000. Profit before interest and tax is what we need, but then it is given in the question. What is given here? After interest and tax. But then we want before interest and tax. So what we can do is profit after interest and tax is 25,000, but then we want it before, which means we have to add interest and tax. Correct. So plus 5,000 plus 10,000. Correct. So divided by, so 40,000. Correct. So 40,000 divided by interest charges 5,000. Okay, I repeat. As per formula, we want the profit before interest and tax. But then in question, they have given profit after charging interest and tax as 25,000. We want it before. Correct. So 25,000 plus interest 5,000 plus tax 10,000. So we are getting 40,000 as our numerator. Correct. Okay. So interest, so 40,000 divided by interest charge is given in the question as 5,000. So 40 by 5 is 8 times. We should express our answer in times, 8 times. Okay, so this is how we should find out the debt equity ratio, proprietary ratio, and the interest coverage ratio. I hope this you have understood properly. Thank you so much.